Hi, everybody. This is Kevin Gormley, CFO for Leading Edge Financial Planning. And today I'm going to talk about our investment philosophy and why we use index based investing as well as dimensional funds, which are their own indexes. So let's talk a little bit about our philosophy. First of all, why should we invest? If you just keep your money in the bank or you go for really low yield type investments or low return type investments, you're not going to keep up with inflation. So, I mean, I think this is kind of an interesting way to look at it. A quart of milk used to cost 9 cents in 1913, and today you get 6 tablespoons for 9 cents. So if you don't stay ahead of inflation with your investments, you're not going to live well. You may still have what was considered to be a lot of money at that time, but you're not going to live well. So investing means taking some risks, but not investing also means taking risks. If you don't put some percentage of your money in growth assets, you're going to be in trouble. So our philosophy at Leading Edge is that capital markets have rewarded long-term investors. Okay, so this is the old Ibbotson chart, 1926 through 14 here, and small cap has outperformed large cap. And it is a logarithmic chart, so it's a lot more money, and that's why we like to make our portfolios a little bit tilted towards small. And then bonds have done a bit better than treasury bills, which has done just a bit better than inflation. So this is the reason why we think that all investors should have some portion of their assets in stocks, bonds, real estate, and other types of investments. The second thing is, and I'm not going to go into it on this video, but there's a lot of evidence that investing in the world actually diversifying across the world actually brings a benefit to investors. It may not always raise the returns, but many times it will lower the risk by investing in 8,000 companies as opposed to just the US. So investing in the world in stocks makes sense. This says fixed income right here. In bonds, the US only makes up 29% of world bond markets, where the stock market, we make up 52% of the stock market, and that's in how much money is invested. And so when we're talking about the UK here, we're not talking about the country, we're talking about investing in companies that are in the UK. So how do different people invest? This is not our philosophy. They try to predict the future. You see people all the time saying what's going to happen in the future. They have a proven system for picking winning stocks. And this sector next year will be the hot sector. The market is ready for a retreat. We hear this every day when we hear the news, watch the news. These three things are said every single day. The next thing is a lot of investors act on impulse. They use emotion. I can't take this bear market. I'm getting out. Everyone's making money. The most depressing thing is when your neighbor is making a tremendous amount of money and you're not. So that can be impulsive. This says they bet their savings on tips and hunches. If you have a smart friend who's made a tremendous amount of money on an investment and brags to you on that, the only way you're going to know if they truly are a brilliant investor is if you get to look at all their investments and all their past investments. And believe me, if they made a tremendous amount of money on one investment, they probably lost a tremendous amount of money on other investments. People hear it on the news that something is bad. You can hear it from someone that you respect. And then my friend works in the industry. You know, doctors often invest in pharmaceutical products. And I'm not saying that's a bad thing. I have a lot of doctors I work with, and I used to work in pharmaceuticals. But the problem is that you know, the drug that comes out, it's already in the news, and it might not really make a difference in the stock price. So if you know information that people don't know, then that may make you wealthy. So there's been all these things that have happened, and the media gets blamed, and they deserve it. So the death of equities in 1979, 3 years before the greatest bull market in history. The crash of 98, they said, can the U.S. economy hold up? And you know what happened in you know, the 1999. That's when the market went through the roof. Retire Rich, A Simple Plan to Have It All. That was in Fortune in 1999. And they were saying at that time you could get 20, 30% returns. Everybody's making money, and of course then the dot-com bubble, and how to reach $1 million. We still see it all the time. So what have we learned? Now, I often talk about evidence, and Paul Merriman is someone we respect and listen to. He says that there's no proof in investing, there's only evidence. And so who are you going to trust for your evidence? Well, we trust these people from academia. Now, why do we trust these people more than we trust people on TV? Really smart people, people that are in the business, if you will. Well, we trust academia because all they're doing is they're doing studies, they're using computers, they're trying to get their papers published, they're trying to find things in markets that can be useful for everyone, not just for one person. So Harry Markowitz found out that risk really does matter. William Sharpe, Eugene Fama, Fama and French, all of these different things have happened in academia. And so I've thought of it, the efficient market hypothesis. What the efficient market hypothesis says is that together we know more than we do, and I know you can't see it, alone. And so this is an example of how the wisdom of markets, the wisdom of crowds actually does work. Participants were asked to say how many jelly beans were in a jar. And some people, the lowest guessed 409 jelly beans was in the jar. And the person that was most off on the high range said it was 5,365. The average of the group, amazingly, was 1,653. And the actual amount when they counted them, it was 1,670. So the wisdom of crowds. And so the efficient market hypothesis, all it says is that there's so many trades every day, very smart people. 80 to 90% of the trades are done by people that look at computer screens, read reports, read everything. 60 million trades per day, that this is the best guess of prices. So if Apple has a new product coming out and it's fantastic, everybody knows about it before it comes out. The things that people don't know are the things that surprise the market, and they're in the future, and that's why you can't predict the future. So what's the best way to invest? Well, conventional money management, and that's just how it's been done probably before 10, 20 years ago. You look to buy companies that are a good value, they're good price, forecasting, and the market's overvalued, undervalued. It generated higher expenses, trading costs, and risks. And so if this is the whole market, what they're trying to do, and the green is the buys. So someone will try to buy the companies that are on sale and sell the companies that are overvalued. It was a disaster, a total disaster. So this is the fraction of mutual funds that survived, that beat their index for 15 years. Just the survivors. This is the survivors, okay? The ones that survived, 19% of the stock pickers and market timers actually beat the market over a 15-year time period. This doesn't even count the ones that went out of business. A lot went out of business. They say that if you put your money in 5 mutual funds, 5 actively managed mutual funds, and that's 5 different people picking stocks or market timing, the chances of beating all of their benchmarks is less than 1% over 10 years. Bonds did the same. So buying and selling bonds and trying to do things that way doesn't work well. So you can do an index strategy, which we like index strategy, which attempts to match the performance of an index. And it's all about low tracking error, which means whatever the index is every day, that's what you have to have in the index fund. So there is an index list. And again, we believe in indexing. We believe Dimensional Funds does a better job, but we believe in indexing. But what happens with indexes? With the small cap, the first small cap index funds were terrible because they weren't tax efficient at all. As time goes on and companies get bigger and bigger, the winning companies get bigger and bigger, then you have to reconstitute the index. And so what we believe is a well-diversified portfolio that emphasizes the dimensions of return, which I'll talk about right now. We overweight the smaller companies out there. We overweight the value companies in an index, and we look for more profitable companies. When I say we, Dimensional Funds does it. We use them as well as other index funds to build portfolios that will overweight these. And so we look at the things that have the highest expected return for the amount of risk. That's what Markowitz found, and we overweight the portfolio. So focusing on what you can control is the science, the evidence, if you will, is great now. Let markets work for you. Don't try to buy and sell. Don't try to pick stocks. 92% of returns come from the asset classes, not from individual stocks. Only 1.6% of all the investment returns actually comes from picking stocks. Consider expenses and turnover, diversify, stay disciplined. You and me are the people that can control our investment futures. If we just buy the markets, all the markets, and get the dimensions of return over long periods of time, we don't have to worry about what the S&P 500 did last year. We don't have to worry about what our friends did last year. We can achieve all our goals, which is to live the life we want to live in the future. So thanks for watching. I'm Kevin, a CPA that does financial planning with Leading Edge Financial Planning. Thanks.